Hello, my name is Xavier Burrell. I'm the CEO. And so, what is an indexed universal life policy, or an IUL policy? They are a life insurance policy. Universal life gives you access to your cash value and allows you options on withdrawals. But the key difference is that it also helps you build wealth. And I'll explain a little bit more about that. But first, let's just go through everything that an indexed universal life policy has to offer. So they have a death benefit, and like all life policies, it goes to loved ones tax-free. It has a cash value, and I'll get more into that in a little bit. It allows for withdrawals and loans. Now, there are provisions, and I will get a little bit into that later. There is a guaranteed minimum rate of return. So the policy has a minimum that it will give you every single year, regardless of the performance of the linked index. And I'll get more into that in a second as well. Cash grows based on the S&P 500 performance. That is not always the case. It could be any index. The most common used one is the S&P, because the S&P has a annualized return since inception of around 10%. So it tends to be the S&P 500. Growth is also tax deferred. And I'll get into that in a little bit, but I will say that the growth, you're not paying taxes out of pocket every single year like you would with a traditional non-qualified savings investment account. And I think overall that the index universal life policies, or IULs, outperforms the market during a recession or the stagnant and bearish market that we're seeing currently. The other major thing that I think is very beneficial for people is that they're low flexible premiums, and we can get into that in a little bit. So, death benefit, I already said it, but I'll just restate it again. The death benefit is distributed to beneficiaries 100% tax-free, and it's payable immediately to your named beneficiary estate. Now, why do I bring that up? Because I just wanted to let you guys know, if you didn't already, that when you have life insurance, if you have a named beneficiary or a named estate, it goes directly to them. A debt that you may owe, or anything of the sort, any kind of debt that you may possibly owe, cannot be taken out of this before it gets to your beneficiary's hands. And the death benefit cannot be touched by any creditor unless it's a credit life insurance plan, in which case they are named, so they can take that, or you put it in your final will. So I think that's just a cool thing for anyone who is looking to get into insurance or anything like that to know. Now I want to get into cash value, because I think this is the most important part of the IUL policies, because this is the part that we focus on. This is the part that grows the money. This is the part that if we were to surrender your policy, this is the value that we get, right? So the cash value, in its simplest terms, is the premium you pay, the total accumulated value plus interest credited. So all the money that you're paying in, its accumulated value, that total amount. So if you're paying if you've put in a total amount of $10,000 over the course of a few years or a few months or however your policy is set up, plus the interest credited, so all of the earnings that you made, that is your cash value. This is the number of the liquid assets in your policy. This is how much money you've put in, and this is how much money that you can pull out and take loans against. This is the main thing that we are going to focus on, like I said. And why do I say that? Because this is the value that is attributed to your net worth. When you apply for a mortgage or when you apply for a business loan, they often ask for your net worth and any kind of collateral. I know this, having had to do some of this stuff recently myself. And your cash value can help increase your net worth and increase your chances to getting mortgages, to getting business loans. So this is a very useful tool to put up when you're trying to determine how much you want to be worth. And it's a bill. That's the most unique part of it. It's a bill, or you've been putting money into this account. It's been growing for you faster than what you would have done if you put it into a Chase or a Capital One investment account, or a Capital One or Chase savings account. Overall, your cash value can help you increase your net worth. And I think that's very important. The other thing I want to say is a gross tax deferred. So I already explained that. I'm not going to keep going over it again, but it's tax deferred. So when you invest the money and you get your interest money credited into the cash value account, only when you're taxed or you're pulling out withdrawals on the interest, or if you're surrendering the policy, is when you get taxed. And it's a tax deferment. So the withdrawal amount or that interest is taxed as ordinary income. It's not taxed under the realized gains tax rule, which is in the 20s to 30%. It's taxed on ordinary income, as if you had just made $5,000, if that was your gain, or if you made $20,000, or if you made whatever, if you've put in investment and then you have that interest, just that interest. So let's say you put in $20,000 and you've made $5,000 on it. That $5,000 is considered taxable income. So let's say overall you have a salary job and you made $60,000. Now for the end of the year, or in the next year when you file, if you had pulled out or surrendered your contract and got that extra $5,000, you would put on your taxes that you made $65,000. And that's the difference. Instead of having to pay the realized gains if you wanted to invest into the S&P 500, which is 30%, give or take, you instead get to put that money into tax bracket of ordinary income. And that is is a huge benefit when it comes to investing into one of these accounts, because we all know how painful it is to have to pay taxes. You don't have to pay it until you withdraw it, and then it's just regular income. And that is a substantially less amount that you'll have to pay depending on what tax bracket you're in. So now I want to get into its performance value. So first we're going to talk about performance in a bear market and the performance in a bullish market. And then that will kind of show you why I think right now is the better time to get into an investment like this, and not having been in the past or the last 5-10 years. And let's get into that. So first, let's go through the bearish market. This is the good, right? So the performance for an indexed universal life compared to the S&P 500 and S&P 500 indexed fund, which is the fund that funds the IUL, this chart shows that performance from 2001 to 2014. And from then, they all start at 500,000. And from there, the fund went up to over $1.8 million in investments, right? You see over here, the blue line is our index fund, and it's up $1.8 million from where it started. Now let's compare that to the S&P 500. If you had put that same money into just the traditional S&P 500, all the same stocks, and followed that same path, you would have only gone up to $1.4 million. And then the indexed fund, which is the underlying asset of the universal life, only did $1.357 million. So we see that during a bearish market, that this fund outperforms the traditional stock market. And that's why now, heading into a bearish market, this is the best time to do it. If you remember back in 2001, and you can see from 2001 to 2002, we see a crash. We see a major drop. And economically, we're in that same position. We are just now starting to head into an economic recession. And we're dealing with stagflation, and we're dealing with a very bearish market. And we see that drop, and then we see it increase up into 2007, and then we see the crash of 2008, which if you've seen my video, what I discuss how heavy that crash was. We see that happen, and we see our index fund, that minimum guarantee, keep you above, still in the green, even though the entire market completely collapsed. And it was the greatest crash that we had seen since the 84 crash, I believe. I believe that one was a bit bigger than the last one in 2008. And then we see continued growth. You only see, I say here, notice that the index life did slow in growth, but it did not fall. So we see here that we see it, even though this was slow and then this was bearish, we see it slow down in growth, but we don't see it ever drop down. We never see we never see a drop. And that shows that guaranteed minimum interest rate is what protects us during those huge crashes like in 2008 or in 2001 and 2002. Now let's look at it from a different perspective. And sorry, this graph is a little less detailed. I had to make this one myself. And I just wanted to give a general idea. That one, the other graph is used by every other investor out there. Every single other person who's selling these products used that graph from 2001 to 2014. Why? Because it shows, that this can outperform other investments. What they don't ever discuss, though, and is why I'm showing this to you guys, is that in a bullish market, this is not the best investment for you. I still work in your best interests. And that's why I want to show you that in a bullish market, this is not a great strategy. And that is because we see here that we see the growth, and we see these huge jumps from 2018 to 2020, from 2018 to 2020, a huge jump, but we don't see it here. Why? Because the investment was capped. You cannot earn more than a certain amount in this investment. It is capped. It slows in growth and has a bit of a ceiling almost, where it will not go above a certain amount, and it depends on the policy. In this example, we see that the S&P 500 outperformed the index universal life policy. And that's why I say that this strategy is best to outperform during a bearish market in the long term. It outperforms a long-term bearish market. So if we're seeing a bearish market for 4 to 5 years, now we've seen it outperform. However, if we see this bearish market for 3 years, and then we see it head into the bullish market, that's when we want to say, okay, the market is starting to recover and we're seeing huge bullish gains. Now, do we think that it's a short-lived bullish market, or do we think that we're heading back into the growth phase of the market? And when we figure that out, we decide if we want to get out of this and move into something that's going to be maybe a little bit more riskier. We're in a bullish market. It kind of takes away that stress of being in a bearish market, trying to invest in risky products. So that's why I say that currently, right now, and for the foreseeable future, for what I see, that the index universal life and annuities both are great investments. Now, I will digress. Annuities are great right now because of the bond market and what's going to go on there. But index universal lives are great because we're in a bearish market in general. I just want to make that clear that they are not one and the same, and there are reasons for each of these strategies. Now, how can you access the money in an index universal life? These are the 4 basic ways. So this is just high level. We have withdrawals. You're able to make a withdrawal on the cash value. I mean, that's pretty cut and dry. You take a withdrawal on what the cash value is. The one major information you should know about withdrawal is that it will affect the death benefit permanently. You will lower the death benefit with the withdrawal, and you can never recover that through a traditional, just straight withdrawal. If you do not want that death benefit to lower, then I would not recommend a withdrawal. Instead, there are other options, such as loans. I think loan is an easy way to take the money out, not deal with losing a death benefit. You're basically, there's no approval process. You are automatically approved and you pay the money back to yourself. You're putting that money back in. Now, there are 2 other methods. This is for complete closure of the policy. There's surrender. You can walk away and get the cash value in whole. Now, when I say that, there is certain rules about this. For one, just like an annuity, there's going to be a surrender value. There's going to be a surrender charge. And we have to make sure that the earnings in the account aren't lost due to the surrender charge. So we have to make sure that we've made enough money in this policy to make sure we can walk away and still be in the green. And then there are surrender rules. So the surrender rule can be that you can't surrender this policy for X amount of years and still get your money back. So you have to have the policy for a certain amount of years in order for you to be able to surrender your policy and receive the money back. And that number changes depending on the policy. It can be 2 years, it could be 10 years. It just depends on the kind of policy that you get. And then a 1035 exchange. Now let's say 5 years have passed and we have been in a bearish market and we have just been continuing to earn and make money. We've been in a bearish market, but overall the S&P is still improving each year because it may have dropped and it's working to get back, but ours is based off the fiscal year's growth. So if it drops like this year, if it stays below 20%, and then next year it grows back to 10%, trying to get back to where it once was, it isn't considered down negative 10%. We got the guaranteed minimum that first year, and then we'll get the 10% from the next fiscal year. We'll get that 10%. And that's how we see that huge growth on this graph, right? So we see the growth from 2008 to 2009, and we see huge jumps here, but we didn't see the decrease with it. And that is the major difference, which is why these can perform very well. But let's say that after 5 years, you have an amazing policy, you loved it, it was perfect during this bearish market, and we're like, okay, Xavier, I loved this product, and I'm still not quite ready to get back into the market. What can we do to maybe move this into an annuity? Because I like the concept of an annuity more than this policy. For example, I get guaranteed income guaranteed for the rest of my life with an annuity. I want that over the death benefit and everything else. So what can I do to move this over? And I would say, awesome, let's do it. I have a 1035 exchange ready for us, and we'll get the product set up and sorted. Now, what a 1035 exchange is you can transfer your life insurance policy into another life insurance policy or into an annuity and not trigger a tax penalty or a taxable distribution for this, because there's no tax penalties with these. So you can move all the money over, including the interest credited, and it doesn't show as taxable income for the year. Instead, it shows as a 1035 exchange. So those are just 4 different methods of these policies. Now, let's just quickly compare indexed universal life and annuities. Indexed universal life has a minimum interest rate and potential for growth. So does fixed annuities, has a minimum interest rate with potential for growth. And the key difference here is a fixed index annuity offers lifetime guarantee of income, a maturity date where surrendering doesn't cost money, and high interest rates. So those are some benefits to it, but all of this in exchange for paying the entire premium upfront the day that you sign up for this policy. On the flip hand, what does Index Universal Life have? They offer loans on the cash value. They offer flexible and low premiums, and they offer withdrawals and a death benefit. So I would say that between the Index Universal Life and fixed index annuities, the key difference is that with the Index Universal Life, you are going to be paying less up front and you're going to be paying over time, but you're losing those higher interest rates that you get with the fixed index annuity. And the fixed index annuity is the exact opposite. You get those higher interest rates, but you have to have all the money up front. And so it just depends on which you would prefer and which you can afford. But the ultimate thing about this is that if the S&P 500 is performing well, then these would perform at the same rate, because the minimum interest rate, the guaranteed minimum, only comes into factor when the S&P 500 is not performing well, if it went negative for the year. If it's positive more than the minimum interest rates of both these policies, then it's positive. So you guys both earn the same amount. But yeah, that's kind of the basic rundown of an IUL policy. And I just want to say thank you for sitting here and listening to me. I may have gotten sidetracked or not. That depends on the edit. But I want to say thank you. And if you have any questions, definitely reach out to me. I am more than happy to talk to any one of you. I would, in fact, prefer if you could reach out to me to discuss this stuff, because not everyone's situation is the same. And we may have a way that you may have said, I don't know if I like this feature. Well, reach out to me, because we can do things that make the policy tailored to you. And I will do my best to make sure you get exactly what you want. So feel free to reach out to me by any of these methods. Phone number 480-395-2460, or my email, xavier@btxfinancialservices.com. That phone number is text messageable. You can text me on that number. It is my actual cell, so you will be able to text me. And in fact, I would prefer to text before calling in case, because I have a lot of spam callers. So emailing me or giving me your number some way prior to, so that the number is saved in my phone. Like when you submit your number through the website, when you're doing the forms and stuff, it auto updates into my phone. So if you call me, but you've added your number into my system, I'll have your number already saved. And if I'm not in a meeting, I will definitely answer your call. Check out my website, btxfinancialservices.com. There are plenty of other resources. I have a free educational kit. I have a little brochure that I have. It's kind of like a beginner's guide to annuities. It was something I wrote that I was writing for myself when I was setting up my company. I wrote it and I set it up myself. And then I decided I wanted to share this with you guys as to why I decided to focus on annuities for the time being. I also have plenty of blog posts and other information on the website. There's more stuff coming as well. I want to kind of go into detail about all the different products and everything that I offer and what exactly I offer. But yes, if you have anything, please reach out. If you know someone that may be interested in this, give them my information. You have the phone number, you have the email. Send them over my information and have them reach out to me, or you can send me their information and I'll give them a call. So yeah, thank you and goodbye.